Today I have a very special guest, Sal Candela. He's an enroll agent, and I know him for years. He's one of the best accountants in the area. And I can tell everyone that he does a very good job. Usually you found the accountant boring, but not this guy. And that's so. And his office is on Metropolitan Avenue, and by the bank used to be over there. I think Chase Bank.
Yeah, by the Chase Bank, also the old Astoria, that's now Webster Bank. I'm with it. I'm right across the street from both of them. Yep.
Yeah, perfect. And we have a show called Expect the Unexpected, Navigating Through Commercial Real Estate in New York. And I brought Sal to the podcast, and I would like to really appreciate for him be here today. And the topic will be 1031 exchange. And also we talked a little bit about owner financing.
Owner financing, with it, you real estate people call it holding a note. Us tax people call it an installment sale. I think it's one of the least utilized areas that can put a lot of money and save people a great deal of money on their properties. And I want to spend some time talking about that today too.
Yeah, so we're going to cover a bunch of stuff, but more important, I've been in industry as a real estate broker. And you always need to have a good accountant, especially when you sell, when you buy, when you lease. And there is a lot of misguided information online. Somebody can just pull up the numbers, but it's not real. You have to be very careful, on that, who you're dealing with, the information's online. That's why always meeting person, make sure the next day that guy is not gone.
Yes, you mentioned something important. You always talked about bad information, and a mutual friend of ours, the attorney John Colonna, mentioned somebody who called us. I actually called him, but then John gave me to him because he was looking to finish a 1031 with it. So he sold the property. And again, he did it himself, with it, and no guidance. And then as I'm speaking to him, it came clear to me that he sold the property and the money was in his account. And the first thing you're going to find out about 1031 is that you can't touch the money. And the minute he said that to me, I said, well, your 1031 is done. There's nothing you can do. You sold property. You're going to pay the tax, and what's left over, you can buy something new. But he's like, oh, but I read online. I'm like, I don't care what you read online. So again, I'm going to say to everybody here that if you're going to sell a piece of investment property, 2-family, 3-family, or a big commercial property, you definitely want to talk to someone before the closing and not after, because if there's a mistake made, we really can't go back and fix it 99.9% of the time. And with it, and this poor guy was on the phone. He was crying his eyes out because he had a big tax bill.
Now, so Sal, maybe one of the first questions I always want to know: why did you get into accounting?
Oh my God.
How did you start it out?
I don't know that I love taxation. I love saving people money, and my biggest advantage.
You want a cup or?
I'm with it. No, I'm good.
You're
with
good?
it. I'm going to be honest with you that my biggest advantage, as you know, is I do a lot of representation work when people get in trouble with the government. And my fondest memory is telling an IRS agent who tried to tell me the law, and I looked at him. I says, I know that's what you think it says, but let me tell you what it really says, okay, and whatnot with it. And sure enough, he didn't agree with me. We went to his manager, and his manager was like, Sal's right.
Wow.
So that is my biggest thing. Is I love fighting the biggest collection agency in the world, which is the IRS. And nothing frightens people more than those 3 letters put together than IRS. So that's really how it got started, was just fighting the government, which I've done for a long time.
So you know the process, and that's how you decided to open up your own practice?
Yes, I opened up my own practice with it. God, I can't believe how long. It's been more than 30 years I've been in business with it. I don't know whether all that time has gone by, but I did do it. Hung up my shingle, and it's been a roller coaster ride since there. Sometimes good times, sometimes bad times, some interesting times with it. Before COVID, I used to lecture nationwide about representation and teach my wares to other people. That was a lot of fun. I've gotten older, and as my son says, grumpier now, so I don't do that anymore. But I still like fighting the IRS. I still like helping people save money if I can with it. I find great joy in finding usually the better way of doing things if possible. And usually that comes with planning and not
Wow.
after the fact.
Yeah, at least you have hair. After many years, I lost all of my hair on it, dealing with the clients. On that. So that means you're more calm than I am.
Clients always are always interesting, and and like same thing like you. I'm sure that people sometimes come with a preconceived notion, with it. People come and tell us that a colleague of mine actually has a seminar that he gives out to us professionals, and we laugh over it, but it's called the tax advice my barber gave me, and it's the crazy stories. So every year he asks us for the crazy stories that we got, and people come and say the craziest things to them, that they heard this through a friend, through a colleague, and it's completely wrong, but they're married to it. They're married to it, and they don't care what you say with it. You can show them the law, you can show them court cases, you can go, and it doesn't make a difference. They heard what they wanted to hear, and they're kind of married to it. And unfortunately, those people will usually end up shopping around until they get the answers they want. So I often remember the guy he was the first person who ever won Survivor, and he won $1 million. And again, true story. He went to his first accountant who said he had to pay $1 million. He had to pay tax on $1 million, and he didn't like that. He went to another one who said you had to pay it. He kept going. He kept going and going. So he finally found the accountant who said, no, you don't have to pay tax on it. And that's the one he went with, right? So he won $1 million on television. He didn't include it. He got audited. And then, of course, he blamed the accountants. Well, I don't know anything. I went to the accountant, and he told me I didn't have to pay tax, and the IRS literally during the court hearing found at least 12 other people that he went to all said, no, we told him he had to pay taxes, and he walked out, right? So people hear what they want to hear. It's normal in this business with it. And that's unfortunately what happens, with it. So a good example to lead us into what we're talking about, with it, people will sit there and say that you can do a 1030. Just recently, we had somebody who wanted to do a 1031 on their primary residence. And you can't do a 1031 in your primary residence. But my attorney said so. I'm like, you need another attorney. Okay, with it, okay? And he didn't want to hear that. And he ended up selling it. Of course, the 1031 company didn't take it, and he had to end up paying tax on it. And he came back to us with it, and he's like, I told you that. Well, my attorney said, your attorney was wrong. I'm sorry to tell you that. Your attorney was wrong. Either he's wrong or he lied to you. I don't know which one. I said, I wasn't there. Maybe you misunderstood him. I wasn't there. I said, but the bottom line was that I kept telling you you can't do a 1031 on a personal residence. You didn't want to hear it. I'm sure you asked around until you got to a person who told you what you want to hear. It's normal. Yeah. It's like going to the doctor, right? You always hear what you want to hear. Okay, with it. So
yeah, I see that also in real estate. People give you what you want to hear. This property is worth $5 million, but actually $3 million.
Yes.
And they're gonna go with the broker who's telling them, yeah, we can do it, $5 million.
Sure,
no problem.
And what happens? They get locked into a 6-month contract, right? They can't sell it. These other offers come in and whatnot with it. I know it well because I shared offices for my first decade of my business. I shared an office with a real estate person, and again, I saw that happen. With it, that you just overbid it to get the listings. Right, and that's how you get listings, and it's not a good way to do business with it. But I know that many times people hear what they want to hear, or if you give them a long explanation, they'll just cherry pick what they want to hear, with it. Again, such as maybe the attorney said to them that your primary residence, maybe, and I wasn't there, but he could have said, well, maybe if you rent it out for 6 months, which is true, you could rent it out for 6 months. And then it turns into a real estate building, and then you can do a 1031. So maybe that's what the attorney said to him, and he just didn't hear that portion of it and thought he can do a 1031 on his primary residence. And you're going to ask me about the exclusion. He was a single person, 250,000. The property had almost no basis to it because he got it from his parents, who had no basis in it. Long story short, he was well over 250,000 in basis, and because of that, he had to pay a great deal of money in taxes. With it, he sold the property for, I don't know, $800,000. It was a lot of money, and he wanted to do a 1031, and it's like, you can't. Well, my attorney said, you can't. And again, I never called the attorney. I'm willing to bet that the attorney was not wrong, and I'm willing to put, dollars to donuts that the attorney might have said to him about, rent it out for a little bit, rent it out for 6, 7, move into an apartment, rent it, get rent, and then we can do a 1031, and that would work, with it, because he was not buying another home to live in. He could have done a 2-family. He could have done something else and saved money.
How long you have to claim it as a investment? Because
well, so the answer is there's not what we call in the tax world as a bright line test. Mm-hmm. There is no bright line test that says you have to rent it X amount of time. It needs to be rented property. So I would do it a minimum of 6 months, and that might include the time that you're trying to rent it at the time. The important part is moving out of it, moving into a different residence, and then renting it. I would feel better if it went for at least a year, but it's not necessary.
Okay.
As long as it's rental property, you're good to go. And again, I'd be willing to fight it at any point, as long as it's rental property and you can show it to be rental property, and you can clearly show that you have moved into it. So many, many years ago, we'll talk about the primary exemptions rules. With it, if you live in your primary residence 2 out of 5 years and own it 2 out of 5 years, a single person can make $250,000 tax-free. A married couple can make $500,000. And this had a gentleman had a vacation home in New Jersey. I said to him he wanted to sell it. He was older. He wanted to sell it, and I gave him the answer. I said, well, you have to move into it, and move into it means move into Jersey. With it, which he did do. He moved into it for 2 years and a month, with it, and he ended up selling it and not paying tax on $500,000 with it. And he did legitimately move. For him to save that kind of money, because he bought it for, I don't know, $20,000, $30,000. He sold it for like $650,000 with it. He was looking at a lot of money in taxes, and for him, we worked out the numbers. And he said, well, to save that kind of money, I will move into it for 2 years. So he did. He took the house. He moved into it. He moved his bank accounts with it. I can tell you that he had the proof that every night he would take the George Washington Bridge with the Easy Pass to prove that he went there every single day with it. It became his home for 2 years and a month. And then he put it on the market. He sold it afterwards. And he didn't pay tax. He didn't pay tax on a single dollar. So in his mind, it was worth the effort to do so, right? To other people, they might not have. But the answer is that he came to us. We told him what the answer was to do it right with it. The other option was to rent it and do a 1031. But he was already in his 50s, 60s, early 60s. He was not looking for rental property. He wanted to start liquidating. He wanted to start putting money in his pocket for retirement. So the 1031, because that's what I told him is the easiest thing to do. It says that you could rent it as a fully furnished home with it. And he was like, I don't want to deal with rental property. So the other one was turning it into a primary residence. And I said, it's got to be a minimum of 2 months, 2 months and then. So he did it 2 months and a month. And then he put it on the market. It was 2 months and it was 2.5 years later when he finally sold it and whatnot. But because he lived there, and we have proof that he lived there, his driver's license was there, happened to be an election year, so he voted from Jersey. He did the whole 9 yards. And by doing so, he saved $500,000 in taxes, which was a good deal of money a decade ago. A decade ago, it was a good deal of money that he sold it.
So you have many people who actually did that sale, and they come into you. I think I did the 1031 exchange. Can I do it? After the sale, you mentioned we cannot go back, right? The deal is done.
I have to tell you that the story that the client that John Colonna sent me was probably the worst with it. There's a lot of things about that particular case that doesn't make sense. Example, He says his attorney okayed it, which didn't make sense to me. But again, it's a California deal. He was just a phone call with it, and 30 minutes later, I gave him the bad news. So most of the time, people come to us beforehand. So thank God for brokers like yourself and attorneys like John Colonna that send people to us beforehand. We can guide them. We can guide them into the right way of doing it with it, because 1031s do have pitfalls on it. You have to do it the right way with it. Many people, what they want to do is sell the property, pay off their mortgage, and take the leftover to buy a piece of property mortgage free. And you can't do that. If you do that, 9 out of 10 times you're going to end up with money. You're going to end up with on tax paper with what's called boot, and boot is taxable. So the term is like kind, which means is that if you have a property worth $1 million with a $400,000 mortgage, you're looking for a property for $1 million with a $400,000 mortgage, and that's not what people are looking for. What they want to do is sell the property, take $600,000 and buy a property free and clear. And in most cases, not in all cases, but in most cases, you end up with $400,000 of boot. And boot, for the most part, is taxable, and it's taxed at ordinary income, which is worse. Okay, which is worse than capital gains. So, as you know, Marek, my big thing with people is planning. We have to plan the numbers. We have people come in. We give them what to look for. We guide them into what you're looking for. This is what you need to spend. This is what the other property you have to mortgage it at with it. And then we go with it, and we guide them. And as they look at properties, they call us in, we run the numbers again, and we tell them, okay, that property works, that property doesn't work, or that property works, except that there's going to be $50,000 of boot as compared to $400,000 worth of boot, right? And we tell them what the tax effect is going to be. You want to plan a 1031 and not blindly go into it if you can avoid doing so.
Sal, maybe just to make it keep it simple, stupid, in the lame terms. Can you explain it? What's really is the 1031?
Sure. So a 1031, it's the 1031 is not a magical number. It comes from the tax code 1031, the IRC 1031s, which define it. It's called like-kind exchange, and ideally you're exchanging properties, right? You're gonna find somebody who likes yours, you like theirs, and you swap properties. But in real life, that doesn't happen. In real life, you're going to sell the property, and then you're going to find something new. And here's some of the key points with it is that when you sell the property, you can't touch the money. It has to go to a qualified intermediary, the QI, who holds the money for you. You can't touch the money. No, your attorney cannot touch the money because your attorney is your agent. So if he touches it and goes into his escrow account, it's a sale. It's not a 1031. So the money has to go to a QI. That's a paid-for service. And many years ago, I used to own a QI with it, and so I was intimately familiar with the rules at that time. With it, the rules have changed slightly, but the rules are the basic rules are the same. So you're gonna sit down. You're gonna sell the property. It's gonna go in. You're gonna leave the money in escrow with the QI. You have 45 days to identify the new property, and you can identify a property on day 5. You can identify another property on day 7. It doesn't make a difference. You can change your mind all the way up to 45th day. And on my contracts at 1159, whatever you identify, you're stuck with. That's the property you now have to buy.
You cannot exchange it, right?
With it. Not after the 45 days. So you have 45 days to identify the new property. So during that 45 days, you can change your mind every day. But on the 45th day, you have to find it.
So how many properties you can identify?
Well, you can normally identify up to 3. Mm-hmm. There are other rules that you can identify more, but it get a little bit complex and whatnot. But normally we do up to 3 properties. So if you're selling a $3 million property, and you want to buy 3 other properties for $1 million each, it's good to go. And we're going to talk about the type of properties in a second. You have to identify the property within 45 days. And believe it or not, Marek, that's the tough with it. Trying to find a property within 45 days is very, very tough with it. And we have seen people on the 44th day get desperate and buy almost anything not to pay the taxes, and that's not a good deal. So I mention that to you because, again, in my 1031 planning consultations, we'll tell people start looking now. Don't wait until you have a contract. Start looking for what you want to do. And for my clients that are leaving New York, they want to go to Florida, then great, go to Florida, start looking for the areas where you want to have a good idea of what you want before the contract. Now, here in New York, it takes 3 months to sell a contract, to sell a building. I don't know why, because in Jersey, it only takes like 30 days to buy a house. So in Jersey, the time frames are much more constrained. They're much more restrictive. Things happen faster. Here in New York, if you wait until the day of the contract, great. You have 3 months and 45 days in most cases, not in all cases, in most cases. But you have to identify the property, and on that 45th day, you're now married. Now, that's very, very important. I'll get to that in a second. At the same time of the 45 days, you have the 180 day, which you have to close within 180 days of the sale of your property. So you have 45 days to identify the new property. You have 180 days to identify it. It's not 45 and 180. It's running at the same time. Now, I've never seen a problem with the 180 days. Closing in 6 months is usually not a problem unless something goes wrong. And I'm going to tell you a horror story. I'm going to tell you a horror story because in doing this for the amount of years, we have a story that can almost match any circumstances. What happened to this husband and wife was they identified the property, and someplace along the line, it caught fire. It burned to the ground.
So they couldn't.
Well, no, they had a choice. They could cancel cancel 1031 and pay taxes, which was not their first choice. Again, they wanted to know if they can change the property. The answer is no, you can't change the property. So either you have to buy the sticks and fix it, okay, with it, which that's what they decided to do. They decided that to buy the property, and they use insurance. The seller fixed the property, and they were able to just close in time. But imagine that. Imagine the property you're going to buy is now burnt, and it's literally sticks. What do you do, okay, with it? And it turned out that the seller with the proceeds was able to get it done. He did get it done, and they did buy it. But imagine if that had been, 170th day. Now what are you going to do? Are you going to buy the property with sticks? So it's a big deal. I will tell you another horror story, which is, again, true, happened to another client of mine, in which the person buying their house, was in a 1031. And they were selling their house with it. But here's the problem. The husband ended up with a massive stroke. He was in a hospital in a coma, and he couldn't sign the contracts, and the wife did not have power of attorney. And what ended up happening was that they could not close, right? They could not close because she could not sign the husband's names. She tried to get a guardianship to do it the right way. It did not get done within the 180 days. And now they're in a big lawsuit because the seller, the buyer of their property, ended up with a huge tax burden that he was not expecting, and he's actually suing them. He's actually suing them for that. So again, things you need to be careful about, and this is an important thing about having a power of attorney for spouses, because bad things happen. And I just had this conversation with a client of mine that, hey, you need to make sure, because here again, everything was fat, dumb, and happy, but he had a stroke. They didn't close, and he can't sign the papers. And his wife's like, I can sign his name. No, you can't sign the name.
It's like expect the unexpected. That's a sad story, but
it is a sad story. And again, it's a lot of money. The buyer of their house is suing them for the fact that he now has a $400,000 tax bill that he couldn't do anything about. He had to pay the IRS, and that was money. So he's suing them for the breach of contract. And I don't know. I know it's ongoing. Maybe they're going to settle. I have no idea. But again, it's a disaster that unfortunately happened. So those are the two strict rules. Let's talk about the type of properties. And people ask me this about it all the time with it. So real estate is real estate. So you can go from selling a rental one family in which it's rented out. You can buy a 2, a 3, a commercial property. You can buy land. With it. If you're selling land, you can go from selling land to buying a rental property. It doesn't make a difference. Real estate is real estate. It doesn't make a difference. And also, there's rules about very, very long-term lease contracts. So if you're buying at least a 30-year lease on something, that also qualifies, although I haven't seen one in 30 years. I've never seen that happen. But you can go from selling a 3-family and buying a strip mall. It doesn't make a difference. Real estate is real estate. So all real property qualifies. Now, believe it or not, chances are that all of us at some point prior to the 2017 Act did some type of like-kind exchange and did not know it. When you traded your car in, believe it or not, that was technically a like-kind exchange. Okay, so prior to the Tax Act of 17, we all have done like-kind exchanges. We just didn't know about it, but believe it or not, when you traded in a car, believe it or not, that used to be a real life like-kind exchange. And for my business clients, they would tell me they traded a car and bought it. We'd have to do a like-kind exchange paperwork for the trading in of the car. People find that interesting. I'm a tax geek, so I think all tax things are interesting. But the 2017 Act killed everything other than real estate. And some in the political party want to get rid of like-kind exchanges all around. It was a very, very big hit. It was on a very, very big hit list. Maybe about a decade ago. It was very, very big on the hit list. And they were trying to get rid of like-kind exchanges for everything. And thank
But
God,
lucky enough, it didn't happen.
it did not happen, and they did kill it for all things other than real estate. And I think that has a lot to do with your lobbyists down in
Probably.
D.C.
Yeah.
The realtors are a good lobbyist point. So it got saved, luckily, because again, most of my clients probably have most of their wealth wrapped up in real estate in one way or the other, not in stocks, bonds, or whatnot with it. On it. And those are the basic rules about it. Is the 60-day rule, the 180-day rules with it, and the 45-day
45
rules
days.
and the 180 rule are the two main rules we have to concern about. And then the other major thing is whatever you get needs to be spent. Needs to be mirror images of one another to a major extent. And what do I mean by that? Obviously, the selling costs come off. So if you're selling a good piece of property, there's going to be title insurance. There's going to be title costs, the broker's fees, and so on. So sometimes it's about $100,000 of slush fund. So it doesn't have to be a perfect to the dot. But often we tell people if you're selling something for $1 million, you're looking for $1 million. Okay, with it, give or take, a small percentage.
So how does it work if somebody lives in, for example, selling 3-family? And lives in one of the units?
So that's a great question, Marek. It happens all the time, with it. So my mother used to own a 6-family, God rest her soul, and she was given bad advice by somebody who said that she can sell that and not pay tax on it because of the the personal residence exemption. So I had to educate my own mother and tell her that didn't qualify. That it was only one out of the 6 units that would qualify for her residence. 2, my father had long passed, so that it'd only be 250, not 500,000. And she wanted to know if that was sure, and I'm like, yes, Mom, I am sure. This is what people pay me for, and whatnot with it. But she again didn't believe me. What else is new?
Like a mom and a son. They always don't. Wow.
True story. I'm not making that up.
You're a tough guy.
It was an interesting conversation, but it was a true story. But the other 5/6, I did explain to her that couldn't go. So if you live in a 3-family, to use your example, and you use 1 unit, for tax purposes, it's 2 different properties. You have the one unit that's yours. So if you sell it for $900,000, to make the math easy, $300,000 would be allocated towards your primary residence. The $600,000 is what we use for the 1031 with it. Obviously, if you want to exchange the entire thing, you can move out of that 1 unit, move into a separate apartment someplace else, rent it, and then the whole thing can be 1031 with it. So, but if you're going to do that for tax purposes, it's almost as if it's 2 different buildings with it. We allocate 1/3 to that, 2/3 to the rental part. The rental portion of it has to be so. To do a 1031, it has to be an income-producing property. So your primary residence doesn't qualify, second residences don't qualify, Vacation properties don't qualify. If you're using it for personal reasons, it doesn't qualify for a 1031. It has to be an income-producing property with it. There is some case law about non-income-producing property. So to use your example, on January 1st, I tried to rent it, and people are coming to look at it, but it doesn't get rented. But we're trying to rent it, and we don't live there, right? We don't live there, and we're trying to rent it. And I got proof of that. With it, so it's going to end up on a Schedule E with zero income with it, and it's going to be expenses. And 3 months later, I 1031 it. Can that be done? The answer is yes. We just have to make sure we dot our I's, cross our T's to make sure that it really was rental property, that I have proof from a rental agreement, right? That you would that your client was trying to rent it, and people went to see it, and I would want copies for my due diligence of buyer, potential renters that came to look at the property. Because again, the IRS is getting better and better with it. Yes, the computer systems are still from the Stone Age, but AI is going to change all of that in the very, very, very near future, and they're going to catch more people trying to play loose and fast with the rules. But that's a very, very good question about mixed-use properties. Okay, with it. And again, 3 families, 4 families. The question is how much of it is being rented and how much. So again, the 4 family, we had a client that basically used the first floor, right? So his answer was it's only a quarter and 5/6. I said, all these years was not that. We're not going to change it now. Basically, we treated the first 2 floors, the 1/3 of it as theirs. The other 2 we used out as rental property. And I told them that's the right way to do it, and to go forth with it. Because the question is how much of it is personal use and how much of it is rental use with it.
Also, I heard, Sal, when you're doing 1031 exchange, there is a different rules, like a 200% rule, 95% rule. Am I going in the right direction? Or no?
I want you to know you're 100% right. It's a little bit complicated for the conversation today.
Maybe that's you have to make the appointment and basically contact Sal directly for that.
That's going to be talking about the replacement property. And I want you to know you're 100% right. There's up to 3. If you do more than 3 properties, it's the 95% rule. It's a 200% rule. With it, they get complicated to understand about, and it all talks about the size of the replacement property that you can get and whatnot with it. So I do have some information here that I can leave you with it on it, but it does get complicated. But I want you to know that in the 30 years I'm doing this, most of the times, the 3 property rule is what most people go with. Okay. When you're selling big properties, when you're selling something that's substantial, that's when the 200% rule and the 95% rule become seriously into play with it. For the average person selling their rental properties, most of the times they're either buying 1 or they're buying 2 or 3 properties at most with it. The current trend of people leaving New York is a good example in which I will tell you that clients are selling here and buying elsewhere. And because of the difference in price, they are buying multiple properties with it. So the 95% and the 200% rule is coming up more. But most of the time, the 3 property rule is going to take effect. We have a lot of people moving into either Florida or moving into Texas, moving into the Carolinas. Carolinas is no longer cheap, so it's not an issue.
So recently, we just did a transaction actually in Florida. The guy did a portion 1031 exchange, but we were looking for the triple net lease building, not a ground lease, just a regular lease building, because you cannot depreciate if you have a ground lease until the lease expires. On it, so we found it. Actually, we will be closing, in the next month.
That's wonderful. That's great and whatnot with it.
Good clients.
It's happening more now that people are exiting New York with it. It's happening. And another important thing about 1031s we have to look about is the tax effect. So we have older clients that really, really are not looking to be landlords anymore. Believe it or not, they're willing to pay the tax price. And they're willing to just have cash. They don't want to be landlords anymore. But a lot of them are still moving. They're coming out of New York. So what's happening is that I'm showing them that if you 1031 into, and I'm going to use Florida because Florida doesn't have an income tax and makes the conversation easier to understand. New York taxes are about 9 to 10% for most of my clients with it. So what they're doing is they're selling the properties here, doing a 1031 to properties in Florida with the understanding that they're going to move to Florida and then sell the properties off. And if they buy multiple properties, they can sell one a year and pay less federal taxes. And more importantly, they're saving the 10% on the state side. So if you have a building that's, a $1 million sale with a $300,000 basis, $700,000 in gain, okay, with it, 10% that is 70 grand. So
that's
just
a lot.
just doing a 1031, the federal taxes, let's assume the federal taxes stay the same. In reality, it's probably going to be less because you're going to spread it over multiple years. But you're saving 10%. And here's the good part. New York State does not chase you down to Florida.
So it doesn't follow you, right?
Not in a 1031, they do not. And so we have more than one client that's done 1031s into other states, Texas, with it, Tennessee, that don't have an income tax. And they understand that later on, in a relatively short period of time, 3 to 5 years, they're going to sell. And they're going to pay the federal taxes anyway, but they're going to save the state. And if you have a big gain, you're still saving a significant amount of money by doing that. And we have clients that have accepted that, saying, yes, we'll do that with the understanding that in 6 or 7 months, they plan to be in Florida. And then starting next year, they're going to start selling off the properties, maybe all at once. Maybe I try to convince them that slower is better, do it every January, sell it and whatnot. And again, you're going to save a significant amount of money by doing that. And they've been very grateful, with it. So it happens more and more these days.
Yeah,
that people are looking to do that.
I just want to add something. We're not giving any legal advice for the clients on it.
No legal advice.
Just the information only.
It's tax information, and again, every situation is different.
Yeah.
So while it may have worked for client A, it may not work for client B.
So that's why you got to meet up with the professionals like Sal.
We need to look at every situation separately because not every situation is the same. With it, we talk about things that work for clients. With it, and every client is different. We have to look at the situation, understand it, and then define what works good for them, what works better for their particular clients with it. And in some cases, it's not. In all honesty, Marek, in some clients' cases, selling the property and paying the taxes is their best option, depending on what the facts and circumstances have to be. And trust me, I don't like when my clients pay $1 more in taxes than necessary. It's actually almost like it's my money. I want you to know that. I act as if it's going to come into my pocket, even though it's not. The truth of the matter is you have to accept what the client's looking for, see what their ultimate goal is, with it. Many years we represented somebody who had nothing. So this story is not about saving taxes. I was a representation client of mine with it. The guy did not make a lot of money, but he owed New York State a great deal of money, well over $250,000. And New York State at that time just started the revocation of people's driver's license. And long story short, he contacted me by phone. He says they're trying to take away my driver's license. He was stage 4 cancer. He needed his car to get to the hospitals, to get to his 4-time-a-week treatments and whatnot. And New York State was threatening to take away his driver's license. And to make a long story short, I was able to stop New York State. When I first contacted the first agent, they were like, well, he has to pay his taxes. I'm like, no, he's going to die. He probably is going to be dead within the next 6 to 9 months, and he knows that. It's stage 4 cancer. It's not good. The reason he owed a great deal of money was that he went through his substantial 401k for experimental medication that did not work. He knew that he was on his deathbed, but not having a driver's license was going to be a disaster. And the truth of the matter is that we actually contacted the assistant commissioner. I told him the story. He could not believe how agents were acting towards this gentleman with it. Of course, he never paid them a dime. And about 7 months later, he left us. And he was only a voice on the phone. I never actually met the gentleman and whatnot with it. But In his circumstances, if you said to me that you're going to take everything out of your 401k, all he cared about was living another day, right? The regular treatments did not work. He was doing experimental treatments that did not qualify for insurance. And in his case, the answer was you do what you have to do because you're trying to live and we don't worry about a tax bill. We've had clients in the same situation that for whatever reason, selling the property and paying the taxes was the option for them because other options would not have worked for them. They could not do a 1031. You couldn't do installments. There's whatever the case happens to be. And that's why I say to you, is you have to look at the facts and circumstances and modify with it and go with it for what's best with the client with it.
Did you hear about, for example, selling the property, doing 1031 exchange, but not into the property, into like trust, Delaware statutory trust or take?
Absolutely. So again, many clients, and we have an older woman right now who's 84 with it and cannot manage. She and her husband built a substantial real estate portfolio with it, but he passed away recently, and she cannot manage the properties. It is beyond her. And she's currently selling the properties, and we plan to do a 1031 into a Delaware statutory trust. So she doesn't pay the taxes, and she's going to get an income from the properties with it. It's an excellent, excellent scenario in which the person is older, and I'm not sure God meant us to live as long as we now do, but the truth of the matter is that she cannot handle the properties. She owns a very large property in the Bronx that she can't handle, and doing a statutory trust. So in her case, selling everything was definitely an option, and then paying taxes. And she's going to end up paying a great deal of money in taxes. Millions of dollars is going to go out the door. The answer was to go ahead and do a Delaware statutory trust so that the money is being invested. She'll have an income from it so that she'll be able to live out the rest of her life with it. Again, it's another great option if that is the option you're looking for. I've also seen, and I haven't seen it personally, I've heard of through colleagues of some rental, for 1031s into like RV parks out west and things like that. Again, there are many options available depending on what you're looking for. Many, many years ago, we had a client who invested into a trust. Now, I have to tell you, you got to be careful about the type of trusts. So REITs, real estate investment trusts, do not work. You cannot do a 1031 into a REIT. You can do it into a tenants in common or a Delaware statutory trust. So again, that is a particular nuance that I won't bore you with the details. Sure. You cannot do a REIT. You can do a common trust, and that's what they did. They are a common owner of some Hilton properties in Chicago. I think it's Chicago, if I remember correctly. That they've been there for more than 20 years and whatnot with. It was property that he inherited. He had no interest in being a landlord. He had no interest of ever dealing with that. And he was looking for a way out. And he invested into a tenant in common type property. It's a condo hotel. It's a condo hotel, which he is a fractional share owner. And he's been getting income from it forever. You're going to ask me the downsides, okay, with it. What's the downside of doing things like that? Getting out of them is not as easy.
So you have to look at the exit strategy, right?
If that is going to be the outcome you want to look at. So
and later on, can you roll it into another property from the take?
You can, but it's harder to get out of them.
Okay.
There's longer periods.
Yeah.
And from my understanding, they're not as liquid as regular real estate would be, and whatnot with it. So again, it's an exit strategy. For the 84 years old, I don't think there's an exit strategy that we're worried about. I think it's an income strategy because she needs the income from it to live what's left of her life, and whatnot with it. And the Delaware Trust was the perfect solution in helping her solve the problem. Right. So she came to us with a problem. Multiple properties that were being mismanaged. What was the other solution? The other solution was getting a real estate property manager, right? Was to get a property manager that could rein it in, because very honestly, She had tenants taking advantage of her because of her age, not paying her, and so on and so forth. It was a mess, and to clean the mess, the easiest way we did it was we found an investor buying all her properties with it, and the money's going to go into a Delaware trust so that she'll have income to survive with it, and so that she has money to go forth. Was sold her primary residence, which she has a $500,000 gain, so she won't pay any tax. She went from being broke, having no money, to now having cash. So now she has the cash to do everything else she needs to get done with it. It was actually a very, very good solution. I was happy to be part of the team.
That's
to make that happen.
You're a professional in that. But going back into our topic, so we were talking a little bit about 1031. It wasn't, we didn't go into details, but that's why you have to meet with Sal in his office. It's like you're going to a doctor, for advice on it. You have to do full examination. You have to bring your taxes. You have to do everything. You have to show it.
Well, let me tell you why it's important. We have to look at the property and actually see what's going to happen to it. So let me give you an example that is more about the installment sale than it is about a 1031. Because in a 1031, it's gone. So most people will tell you that long-term capital gains is 20%, and that's what they'll stick with. So the back of the papers, they'll come to us that they bought a piece of property for $400,000 30 years ago, and they're selling it for $1 million, and they're gonna pay $600,000 in taxes, and they'll sit down at 15% and come up with a number. And then I'm going to warn them that, well, first of all, that they're wrong, right? Because of depreciation, their basis is close to zero, right? Because most rental real estate has 27 and a half years, which means that due to the magic of depreciation, they're not paying tax on $600,000, they're paying tax on almost $1 million. People are already blown away by that, okay? Blown away by it. They're like, you're wrong. Well, I paid money for it. I'm like, yes, but depreciation took back that cost. It puts money in your pocket. You now have to pay tax on that. But also, that depreciation is recapture, right? You have depreciation recapture that we have to deal with and calculate if there. And depreciation recapture is taxed as ordinary income. So it's not taxed at the long-term capital gains rate. It's taxed as ordinary income. And that's a whole nother tax break. So we want to plan. And that's what I say to you is that back of the paper is fine for a quick number. What you want to do is look at the particular property and decide what's there. Also, and we have this, there's sitting on my desk right now, in which the depreciating records have been destroyed, and we have no records of basis, zero. We have no idea what the basis of the property is, and we now have to reconstruct those, going back, in this case, I think it's 12 years or 13 years he owns the property. And we have to go back and reconstruct it because the rule at the IRS is very simple. Everything has basis. Everything has basis. But if you can't prove basis, then the basis is zero, and you're going to pay top weights. So having to know the basis, and sometimes those records are not there. And it has happened to us that people have come to us, and because the accountants have died, especially older accountants, they have died, and the depreciation records are not there, or using non-professional accountants, using storefronts or insurance agents who do tax on the side. Anyway, that the records are not there, and we can't figure out the basis. And if you can't figure it out basis, the basis is zero, and you're going to pay a lot more money in taxes. So that's another reason why you really have to talk to a professional before you sell the property and the property is sold, because if we have to go back and make up records, that can be time-consuming and can be costly, depending on how many years we have to go back and look at things. So that's another reason why I say to you is that not selling my services, but I am saying to you again is that we need to know, we have to have a good understanding of the property. And not every property is the same. Some of them, the records are black and white. It's very easy to do. With it, you throw it on a spreadsheet, they come back. Other times, like this person who came to us that his accountant died. He passed away, and we don't have the records. And I've contacted the person who took it over. They're not being cooperative. They don't want to give us the time of day. And I looked at my client, and I said to him, I says, no, we have no choice but to go back over the last 13 years and reconstruct this.
Can you request it from IRS, copy of the records, or?
Yes, but it's very difficult to get the depreciation records
Okay.
and whatnot with it. But the answer is yes. It's a matter of time, effort, and money. We have to pay for copies of the returns. And if the returns are electronically done, you're going to get electronic copies of them in which the depreciation document hopefully is there and not there. So sometimes we have to go back, and that's what we're doing in his case. We're pulling up the records from ACRIS. We're pulling up the information from ACRIS and whatnot with it, and reconstructing it. And again, in February of a tax season, it's kind of difficult to do, but that's what we're going to do for this client with it. But it makes a difference. See, you have to know where you're starting. And I often say that to clients. It's hard to know where you're going to end up if you don't know where you're starting, right? You have to know where you started and have a good idea of where we're going from there.
Yeah, good stuff, because you have to see what issue you're going to have. Like in real estate, many clients, they're not telling us the truth from the beginning, and later on, like 2 months later, we just finding out, oh, I didn't know that I have to do that, and that's basically going back to the accounting. You have to be honest,
Well,
tell everything on it.
Again, you do, and it's no different. And I hate to say this because I'm not a doctor, but it's like going to a doctor and not telling them everything, right? The more they know, the better they have.
Yeah.
And more importantly, I often tell people that you go to a doctor and they don't know what the circumstances is. They have to explore. In the old days, and I know it's different now, but I'll show you my age. The exploratory surgery in which they used to open you up just to look at what was inside. Now with MRIs and CAT scans, I guess it's no longer true. But in the old days, they would do exploratory surgery. We need to look at something. So when people call me up and say, well, I bought it for this, I'm selling it for that, what am I going to pay in taxes? It's a little bit more in depth than that. With it. If it's rental property, example, in my parents' case, for the sixth family, at one time, the sixth family was half owner occupied, with it. Well, that's a very, very big difference than it being 5-6 with it, which was the time my mother was looking to sell it, right? But at one time, when I lived there, my parents lived there, my sister lived there with her husband, it was literally half occupied, right? And that's a very, very big difference with it. It makes differences with people. And depending on how good your records are, depends on how good we have the ability to help them with it. And sometimes we have to sit down and do it. And that's what people don't want to hear. They like the back of the records, or they want to hear that, long-term capital gains is 20%, and they do 20% with it, not knowing about depreciation. Depreciation is one of those things that people don't like. And we've had people come to us and tell us, well, I don't want to do depreciation because I don't want to depreciate the house. I don't want to have to add it back later. What they don't know is that according to the IRS law, not Sal's law, not Marrick's law, depreciation is taken into consideration whether you took it or not. So if you didn't take the depreciation all those years because you didn't want to deal with it at the end, let me break the news to you. You're still going to lose it, so you might as well take the depreciation up front. And we've had people come to us who've had non-professional preparers to do their returns, in which they've left depreciation off with the thought process that they wouldn't have to do the recapture, and you can have a huge argument with it. So we had somebody who came to us for a 1031 consultation with it. I did it, and they did not take depreciation. I explained to them the issue with it, and their preparer emailed me and the client back and said, well, I don't let my clients take depreciation because I don't want them to do the recapture. And I said, well, that's interesting because according to United States Tax Court, and with it, you have to take it no matter what. That's the law. But I don't care about that. I'm like, I like that. I'm looking forward to explaining that, and I hope your errors and omissions insurance is in place when you get sued, with it, because when your client loses that, and you say I didn't care, I hope that's going to be your defense and whatnot with it. And I looked at the client and I said, here it is. Here's the black and white. Now you can do with it as you want, with it, because before this you can plead ignorance. Well, now you can't because here it is in the black and white, right? You have to do the recapture of the depreciation regardless. So there's more to it than just the back of a yellow paper, 20% with it. You want to get a real idea of what's going to happen and why is it important? Because and this is really very technical, and I don't want to bore anybody with it. But when you put the new property in place, you have to you take the property, the basis of the old property. Yeah. So why it's very simple for the attorneys to do, it's very simple for the QI to do. It's not so simple on the tax papers, because what you're actually doing is you're going to use the basis of the old property for the new property, okay, with it. So it's going to carry. So it needs to be right. And if there's mistakes in the past, it's a mistake that's going forward in the future and whatnot. That's why it's important to get it fixed. And very often when we come across a messy property that is not, in which we're going to do a 1031, very often we put the return on extension and then deal with the math of it later when it's summer, and we can deal with it and put time and effort into it. Which is always an option. Always an option is that you can do the exchange, and as long as you don't take any money out of it, it's going to end up on the return somewhere, and we can figure out the actual numbers and get them right when it's a little bit quieter, and we can think it out in a better way.
So really, this is very important. Especially you got to look into later and substitute basis. You know,
you have to get the basis, because in the actual tax program, it actually refers it back to the original property. It stays there. Yeah. It doesn't really disappear. It actually stays. It gets absorbed, but the numbers are actually there.
So you have to, no matter what, take the depreciation on the building.
You have to take depreciation on a commercial property. Mm-hmm. I'm sorry, on a residential, commercial, on a rental property. Yeah. Be it commercial, be with it. Yeah. Depreciation is not optional, and people think it is. It's not.